David, what gives you the confidence to say rates haven't peaked? Welcome.
Thank you for having me. Yeah, I think that it's hard to say, but look, until we have, as an economy, gotten smarter about how we allocate capital, we're not going to really see inflation get under control. There's 20 years of malinvestment that we've incurred over the last few years, as represented in zombie stocks and other businesses like Carvana that have had huge market caps and we've seen collapse. I think that's at the core of what's going on. And as long as we've got bad or good capital chasing bad investments, we're going to have a problem with inflation. And the only way to really slow that down, to put the brakes on that activity, is for the Fed to keep raising rates and to quantitatively tighten.
But even if the Fed keeps raising rates, we could see the 10-year drop, right? That's what we're seeing already. The market is interpreting their hawkishness as a negative in the near future. So why wouldn't that send rates even lower potentially?
I think, look, we've got an inverted yield curve, and that's never a good sign. I think that reflects the fact that interest rates are still outpacing, that inflation is outpacing inflation. So, or inflation is outpacing interest rates. And so as long as that's the case, we're going to still have an inflation problem. I do think the market is more forward looking than it's kind of ever been, and it's already looking past the rate rise events, in the 10 and the 30. But I don't think that means that we're out of the woods yet. I think the markets are forward-looking and optimistic, but in the near term, we are not yet out of the woods. And I think rates do have to inch up a little bit more before we find our way out of the woods.
Yeah. So what does that mean for your view on the stock market? Where do you think you differ most from the consensus right now?
I think we differ most in just a real focus on underlying value and intelligent capital allocation. I think we've gotten away from that in many ways in our markets and in our economy. Too much FOMO, too much YOLO, too much chasing crypto or hot IPOs. And we really advocate for folks to get back to intelligent capital allocation, value investing, if you will. But it's really more about just making sure you're buying assets at the right price, that you're buying businesses that actually generate real returns on invested capital, real cash flows. And if you can, focus those investments on the companies with the highest returns on invested capital and highest cash flows, because those are the underlying entities that can create value for you over medium to long periods.
Would you change your tune on all of this if you start thinking, maybe rates have peaked?
I would not. I think that's one of the benefits of focusing on intelligent capital allocation, is that you keep the same theme all the time. Your strategy doesn't change. It doesn't whipsaw with the markets or interest rates or fads. You focus on really doing your diligence. You focus on fundamentals to understand profitability and valuation. It's not a dissimilar message from what Warren Buffett or all the sort of wise investors over the years have said. Because that's, at the end of the day, that's what the stock market, Kelly, is all about. It's about intelligent capital allocation. And if your strategy is focused on that, then you really have something you can rely on through good times and bad.